On April 2nd, Donald Trump stood in the Rose Garden and announced the single largest tariff package in American history. He called it Liberation Day. The stock market called it something else. The S&P dropped 10% in 2 days. $5 trillion in market value. Gone. The worst 2-day wipeout since 2020. And every economist, every analyst, every talking head on CNBC agreed on one thing. This was a disaster. And then the market went up. Not a little, not a dead cat bounce, all the way back up, record highs. And the question nobody on financial television is actually answering is, why? Because if tariffs raise prices, slow trade, crush corporate earnings, and historically precede recessions, and every expert agrees on this, then why did the market respond like someone just cut rates by 2%? The answer isn't complicated, but it is deeply uncomfortable. And once you understand it, you'll never watch financial news the same way again. Let's go back to where this started. Before Liberation Day, Wall Street was already nervous. The S&P had been quietly sliding since February. Inflation was still sticky. The Fed wasn't cutting. Corporate profit margins were getting squeezed, and hedge funds were sitting on some of the largest short positions since the pandemic. Then, April 2nd happened. Trump announced a baseline 10% tariff on all imports, plus targeted tariffs on 57 countries. China got hit with 54%, the EU with 20%. Vietnam, which had quietly become America's manufacturing escape hatch from China, got hit with 46%. The reaction was immediate. Markets went into free fall. $5 trillion wiped in 48 hours. Jamie Dimon warned of recession. The IMF downgraded global growth forecasts. Ray Dalio said this was worse than a trade war. Economists started using the word stagflation, which, if you don't know, is the economic version of getting food poisoning at your own birthday party. And then, on April 9th, Trump paused most of the tariffs for 90 days, and the market exploded. The S&P ripped 9.5% in a single session. The Nasdaq jumped 12%. It was the third largest single-day gain in the index's entire history. CNBC anchors were visibly confused, and financial Twitter collectively lost its mind. But here's where the mainstream explanation completely falls apart. The tariffs weren't actually gone. The pause only applied to 57 countries. China didn't get a pause. China got an escalation. Tariffs on Chinese goods went up to 145%. And those 57 countries, they still had the baseline 10% tariff in place. The fundamental trade disruption that was supposedly causing the crash was still there, mostly worse. So what actually happened? 3 things, and they had almost nothing to do with trade policy. The first thing was a short squeeze. Going into Liberation Day, hedge fund short exposure was at its highest level in years. These funds had been betting against the market massively. When the pause was announced, the market ticked up slightly. That was enough to trigger margin calls across dozens of over-leveraged short positions. And when you get a margin call, you don't sit down and debate trade policy. You buy back your position immediately, or your broker does it for you. That forced buying pushed prices up, which triggered more margin calls, which triggered more buying, the classic feedback loop. The second thing was the CTAs, commodity trading advisors, systematic algorithmic trading firms that don't read news, don't care about tariffs, don't care about China. They follow price trends mechanically. When price goes down, their models say short. When price goes up, their models say long. Goldman Sachs estimated CTAs were sitting on a roughly $200 billion net short heading into the pause announcement. The second prices crossed certain trigger thresholds, these models didn't flip to neutral, they flipped aggressively long. That's hundreds of billions of dollars of automatic buying, instantly. The third thing were options dealers. This one is boring but important. When retail investors and funds pile into call options, bets that the market goes up, The dealers on the other side of those trades have to hedge themselves by buying the actual underlying stocks. The bigger the move up, the more they have to buy. It's mechanical, it's automatic. And in a market where same-day options now represent over 60% of all S&P trading volume, the hedging flows are enormous. Spot Gamma had flagged a negative gamma environment going into the announcement, the exact conditions where dealer hedging doesn't stabilize markets, it accelerates them. Short squeeze, CTA flip, options dealer hedging, 3 dominoes, same direction, all at once. That's your rally. That's the whole story. And here's the uncomfortable truth underneath all of this. The stock market is no longer a measure of economic health. It hasn't been for a while. It's a system, a mechanical, reflexive, algorithmic-driven system where the actual news, the tariffs, the trade war, the recession risk, is just the trigger. The real move is always about positioning, about who's caught on the wrong side of a trade and how fast they have to get out. 63% of all U.S. equity funds are now passive index funds, trillions of dollars that don't analyze companies, don't read earnings reports, just buy whatever's in the index automatically. The active money that's left is dominated by massive multi-strategy hedge funds running at 4 to 8 times leverage with strict drawdown rules. When they hit their limit, they sell immediately, no debate. And layered on top of all of this is a $2 trillion per day options market, forcing dealers to buy and sell the underlying stocks in real time, just to stay hedged. This is the market in 2026. It's not Warren Buffett reading annual reports in Omaha. It's algorithms reacting to algorithms reacting to algorithms. And the narrative, the trade war, Liberation Day, the pause, that's just a story people tell afterward to explain a move that was already mechanically inevitable the moment positioning got stretched far enough. So the next time a market goes up on genuinely terrible news and a CNBC anchor looks directly into the camera and says markets are pricing in a positive resolution, just know they have absolutely no idea what they're talking about. But here's why this actually matters for you. Because if the market can rip 10% in a day while a trade war is actively escalating, it can also drop 10% in a day when everything looks fine. The fundamentals stopped driving short-term price action long ago. What drives it now is positioning, leverage, options exposure, algorithmic trigger levels most retail investors don't even know exist. Which means the single most dangerous thing you can do right now is watch the market go up and conclude that everything is okay. The tariffs are still there. The trade war with China is still escalating. Corporate earnings estimates for the back half of 2026 haven't been revised down yet, but they will be. The 90-day pause bought time. It didn't buy a solution. The market went up because of how it's structured, not because the problem went away. And if you want to keep getting the actual explanation, instead of the polished, advertiser-friendly version that conveniently leaves out the short squeeze, the CTA flip, and the $2 trillion options market, hit subscribe. Because the market that your parents told you about, the one where stocks go up when the economy is good and down when it's bad, that market is gone. What's left is a feedback loop. And right now, nobody on TV is telling you that.